I put about $1,000 into stock options, and this is how it went. I went and bought a SPY call option, which I'm making money on the way up, and you can see I made 20%. That's going to be very important here, and I made about $158. Now, why do people care about this? There are many people who want to use stock options to make passive income so they can buy a contract, let the price of it go up, and then they can use this while they're at their 9 to 5, while they can have some side income for the month. And I want to show you exactly how that's done the right way. But let's go on and let's get into it. So as you see here, this is called the SPY $465 call option expiring February 16th. So I bought one of these and then it went up $160 and I can sell it and take the cash out and use it for whatever I need, to pay some taxes, to pay bills, to use it to go walk my dog, and then we stop at the store and I pick him up a treat. Whatever you want to do with it, that's up to you, but you got to know how to do it in order to make it work. And I have these two glass bowls right here. One is going to be money green for wins, so you can see what that means, and one is going to be for losses, so you can learn a skill here that can pay the bills. What is it called? The 1-to-2 risk reward ratio. So if you appreciate that, put the word class in the comments. This is going to be a lesson, a full lesson. Class is in session. Write the word class in the comments and hit the like button if you appreciate this real in-depth tutorial. And while you're at it, you can go on and join KG's Stock Market University for the gifted, so you can get more lessons like this and see it in real time. Again, it costs $10. This is going to be some of the best $10 you ever spent. That's about, I want to say 30 cents a day. So I'll see you over there. The link is going to be in the top comment. But let's get right into it. So I told you that I have, let's say, $1,000 into an option. Let's scale this down so you can see how it works practically, the 1-to-2 risk reward ratio. So let's start it like this. Let's say that instead of using my whole 1,000, I only use 100. No, I don't like this 100. This is an old 100. Let's use a nice blue 100, right? One of the new ones. So we put one of our new $100 bills into a stock option. And what kind of return are we looking for in this strategy? We are looking for, again, about 20% up, like we have right here, before we do one of two things. Either take profit on it, aka sell it and take the money, or we're going to raise our stop loss higher than our buy price. So now, let's keep it simple. You ready? Let's get into it. We get into an option, and let's say we put $100 into it. In this strategy, you are either going to lose $10. Hold up, let's turn them around. Or you're going to make $20. Remember, this is how it works. You're either going to lose 10% or make 20%. So let's go through that. And we got our winning bowl right here, the green one. And then we have this one right in front of me. This is going to be our losing bowl. So let's start. Put $100 in, boom, and we get into a stock option. You know what? The first one, we won. We made $20. Let's go. Oh, wrong bowl. Hold up. The green bowl with the little green light on it right here. And this is going to be our lose bowl. You can kind of see, if you look really hard, it's kind of orange over here. So we just made $20. Let's go. We did it. We now have $120. You know what? We don't trade the whole 120. We don't trade the whole 120. We won't do that. What we're going to do is we're only going to trade the 100 again. So we took profit. We got profit. Now we have a total of $120. But this is in our win bowl. We put 100 back in. Remember, if it goes up 20, we put our stop loss higher or we sell it. Or if it goes down 10, you know what? We got to take the L on that and we sell it. We put $100 in and boom, we lost. Dang. In the loser bowl, $10, womp, 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 we lost. But now, let's think about this. 50-50. You won one, you lost one. Yo, hold up. How much money do you have? You made $20. You lost $10. Put these together. That means you now have your original 100 plus 10. You have $110. You won one, you lost one. Let's keep this going. You put your original 100 back in, not the 110 that you currently have. When you average out, you made 20, you lost 10. So you put in 100 again, $100 trade. You lose again. Okay, you lost. Oh, wrong bowl. Over here, right? The orange. So that means in this case, you lost once, you lost twice, but you won once. So you lost 2 times, and that lost you $20. And you were only right 1 out of those 3 trades, and you are back at break even. You lost 20 and you made 20, so that means you have $100. Let's keep this going and see how it's protecting you towards the upside. Now, I can't tell you what to buy, hold, or sell, but I can tell you that I've been extremely profitable trading, and at the end of the day, it's just knowledge and math. Now, let's do it. You put your 100 back in. You are now at break even. You win again. You win again. So now you've won once, you've won twice, you've lost once, you've lost twice. So you now have $40 in wins and $20 in losses, which means you now have $120. Let's say that you keep this going a few more times. You win one, you lose one, you win one, you lose one. You know what? You win one, you lose one, you keep, oh man, I lost again. Yes, I won again. You know what? So you won 4 times, you lost 4 times. Let's do it one more time. You put another $100 in. Remember, we're just going to trade the 100. You lose again, you win again. So in this case, and let me put the 20, right? Let's do it right. You win again. Let's count our winnings. So we won once, twice, 3, 4, 5. We won 5 times. And we lost 5 times. 1, 2, 3, 4, 5. So that means, hey, we got $100 in wins. Let's trade that out for another blue 100. So we won $100 and we lost $50. So that means all in all, how much money do we have? We started with 100. We now have $150. We have 150 freaking dollars after it's all said and done. But remember, when we lose, we cut out when we lose 10, and then we cut out when we gain 20. This makes it mathematical so that if you were to win 5, in this case, and it's just $100, you just made $100. So you got to add your losses. You lost 50. You are up 50%. 50% from 100 to 150 just because you limited your downside. Now, here's the major part that I want you to see. Notice how I said you don't necessarily have to sell when you're up 20%. What you could do is put a stop loss higher because sometimes we cut our winners too soon. What if your option, like I was showing you before, what if it goes up 20%, 30%, 40%, 50%? What if it goes up 100%? And this patience and this discipline is what's going to allow you to stay in these trades the appropriate amount of time. You can't always catch the top, but you definitely don't want to be selling it at the bottom. So you put your stop loss on when you're up 20%. So let's say you get into another trade. You get into one more trade with your $100, not 150. You got to protect those profits with your $100, and then it goes up 20. Okay, you're winning this one. And then you put your stop loss on it, a little higher than your buy price to protect you. And then it goes up another 20. And then it goes up another 20. And then it goes up a total of 100%. You now have another $100 in this. So what happens here? You now have $200 in wins. Your original $100 that you had, you also have $50 in losses. Family, you are making your money grow at an exponential rate. Why is this important? Because you have limited your downside to every single trade. You can only lose $10. But before, your goal was to make $20, but you made $100. In stock options, you've seen people up hundreds of percent. You've seen people up thousands of percent. Why? Because they're protecting their downside and they're making sure that their upside is unlimited. If you appreciate videos like this, again, I ask you to put the word class in the chat so I know that you are paying close attention to this. This is called the 1 to 2. Hold up. Don't fall on me now. Hold up. The 1 to 2 risk reward ratio. You lose 10%, you're trying to make 20%. Did I move my 20s? You're trying to make 20%. That's the important key here in this strategy. You got to find out if you can stay disciplined and then make it happen for yourself. So mathematically, you can win. Now, what am I looking to do this with going forward? I'm looking to do this with a little company, maybe you heard of it, called Apple. Apple has a new price target. And they're saying, Wedbush said this, they're raising their price target for Apple for next year to $250 a share. Does this mean that it will happen? No, it does not mean that it will happen. But we can see that the institutions, the people who own 80 to 85% of the stock market, are trying to pump it up, and we want to be along for the ride. Apple is something that I consider a long-term hold, but you can also make money in the short term, and I encourage you to have more than one account. Have a long-term account and at a minimum a short-term account so you're not mixing the two. So now, let's check another piece of information on Apple, because we don't want to just trust the institutions. We want to take what they say with a grain of salt. But how do we know when they're moving? We got to watch what they're doing on the charts. Apple is currently, at the time of this recording, $193, and it is up 35% this year. If your entire portfolio is not up 35% this year, that means that you would have been better off not trading and just owning Apple stock. That's what I want you to understand. And most people, that makes a lot of sense, but you got to do your own research. That's extremely important. Now, check this out. There's a buy zone on Apple that I can see on the charts, and that's about 189 to 192. Now, I can't tell you what to buy and when, but I can tell you if I see this range, I'm going and I'm buying 5 shares of Apple, right? Because then that's going to give me about $1,000. So then I can do this. Hey, if I lose 100 or make 200, now you can see where I'm going with this. Before it was 10 and before it was 20, but I'm going to scale these up to 100 down, 200 up. And you can scale this to whatever ratio you want or whatever size of your portfolio that you want. But the 1 to 2 risk reward ratio keeps you limited on the downside, and the upside is unlimited. So I'm looking to buy 5 shares of Apple in this range if it holds. But if it breaks under that 189, if it breaks under that 187, you can see that I'm going to say, oh, I got to cut out of my trade. My long-term Apple I'll hold, but I'll have to cut out of my trade because I'm not looking to go unlimited on the downside. Now, many of us have overstepped and stayed too long in trades and got smoked behind that. But what about where the sellers are? This is where I would buy it. I know there are sellers between 193 and 197, but once we break past 197, oh, I see a double top. My people who are in the class, you know what time it is. Double top means this is resistance, crazy resistance, and this is at 197. But if we break past 197, this is looking like a technical breakout to head towards that price target. Might not hit it, but to head towards that price target that they are calling. Now, if you appreciate that, again, I want to see you on KG Stock Market University for the gift of some of the best $10 you ever spent in your life. I see you over there. Hit the like button, and if you want to support the channel and get your uninvested cash to work, they're giving 5.1% APY on Moomoo, and you can get up to 15 free stocks. I love y'all. I appreciate y'all. And just know this, family. If you can't do the heat of these hot stocks and stay out of the kitchen, consider investing in index funds. Again, I love y'all. Hit the like button. And then when I say hit the like button, does it light up? Because I heard that that's happening now. But I see you on the next one. Take care.